Every farmer believes that going direct to their bank is the cheapest way to get a loan. And let's be honest, that seems obvious. You can cut out the middleman, save on the fees, and you deal with a bank you've been loyal to for decades. But what if I told you that belief that a single decision to go direct is the most expensive decision that most farmers make? What if I told you that your loyalty is costing you hundreds of thousands of dollars, even millions in lost opportunity, weaker terms, and reduced borrowing power? The hidden cost of skipping a broker isn't the fee, it's the deal you never saw, the competing offer you never received, and the structural advice that could have unlocked the property next door. In this episode, we're going to expose the true cost of going it alone, and I'll show you why having the expert in your corner is the single most profitable investment you can make in your farm's growth. Welcome to Dollars in the Dirt. I'm Brecken Curtis, and this is where we break down the finance side of farming so you can grow your operation, buy that next property, and build real wealth. Let's get into it. So let's jump into the first hidden cost. One bank equals one policy. There's going to be one lens and one outcome. And when you go direct to a bank, you're getting one credit policy, you're getting one interpretation of your numbers. And this is really important to understand, that the bank manager that you go and sit down with isn't going to tell you that the bank next door might have a different policy on his business that might be better for your operation. Whereas if you go to a finance broker, they're going to have access to all those different banks. They're going to understand all the different policies of those different banks. And they're going to make sure that you're married with the bank that actually has an appetite or policy that suits your business. So it's really important that you understand that by going directly to the bank, you might think you're going to get a cheaper rate, but you might get with a bank that actually doesn't have appetite for where you want to take your business or where you want to grow. So what does this mean for you? You don't just risk decline, you risk being labeled incorrectly in the bank system, which can follow you around. And what this means is, if you go to a bank that might have been your bank for a long time and they say, unfortunately, we can't help you in this circumstance, for whatever reason, you don't fit our policy. The next bank you go to is going to say, well, why didn't that bank give you the money? And this is the hidden risk of just going directly without using a broker that understands the industry, understands the policies, and understands that if we go to that bank, it might have a detrimental impact on the outcome of the loan. Most farmers think that if the deal's good enough, it'll get approved. And the reality is that banks are hierarchical. Outcomes depend heavily on the banker's experience, their credit delegation, their willingness to fight internally for your business. And I've seen this time and time again where we've had a loan application presented to multiple banks, different experience across the bankers. The experienced guys get it across the line. The inexperienced guys, because they don't have any experience in that sort of loan or done, seen that before, they don't have the experience to take it to credit and fight. And internally, the loan gets declined. And if you're a customer and you walk into that one bank where you've got an inexperienced manager, well, the outcome's not going to be what you're looking for, and it's not your fault, but it's just the way that, the bank's set up, and that's just how it is. In the opposite circumstance, if you go to a broker, they're going to know who the best people are in the industry to work with, and they're going to make sure they get the best outcome for your business. The wrong banker can kill a good deal. A great banker can get a marginal deal done, and that's the difference that we're playing with here, is that the broker should know who actually has influence, who understands the ag risk, and who's worth taking the deal to. And that's the reality, is that, in banking in rural Australia these days, the bankers are becoming younger and younger. The customers don't have the experienced bankers that often in the past have been able to get things done. So, you're putting yourself at risk, and it's going to cost you a lot of money. If you go to a banker, it might mean the difference between buying the property or not, and the difference between whether your business expands or doesn't. The next hidden cost is becoming a reality for more and more farmers. That's the loyalty is risky when relationships change. And what we mean by that is that, bank managers often move on. The tenure for bank managers in regional towns now is, 1 to 2 years max. And this is the challenge that banks have, is that trying to keep staff in rural towns is getting, more difficult because, people are drawn to the coast and they don't want to live in these towns. And the business is still there for the banks, but it's just having the people to be able to service it. Enticing people to work in these towns and remote locations is often hard. And what that means for a customer is that, you've got constant change, constant turnover of bank managers having to explain your situation regularly. The bank manager mightn't understand your industry. And what that has is a massive impact if you're looking to expand. If the banker you've got at the time doesn't actually understand where you want to take the business or where you're going, can have a massive impact, and this can cost you a lot of money. So what is the hidden cost here? Borrowers often don't realise their relationship has weakened till they need money. So what we mean by that is that, You mightn't realise that the bank manager changed 6 months ago, and then all of a sudden the next door neighbour's property comes for sale. You're trying to build a relationship with a new person in a hurry. They don't understand your business. And then all of a sudden you can't access the money to buy the property and the opportunity gets missed. So, that's a massive cost to your business. That property mightn't come back for sale for another 10 years or maybe never again. You can't really put a price on how much that's costing you when you're not prepared and not able to execute when you need to. So loyalty only works when there's someone left to be loyal to. And this is the thing, when there's constant change in bank managers, it's hard to be loyal to a bank when you don't actually have the relationship to the person on the ground. And this is a massive cost to a customer. Not having that relationship locally, or that person is constantly changing, it makes it really hard to be able to articulate your business. A rural business, let's face it, is a business that's not simple to communicate with someone around how it operates and getting to know the issues around season, commodity price risk. The fourth hidden cost when you bypass a broker and go straight to the bank is that brokers just banks. They know people, and brokers are the connectors, not the middleman. They're the person that know who the best bankers are in the bank and able to connect you with them. You don't really have the time to go to a bank and find out who's the best person to help me get this finance across the line. And what happens is you get the person that's been delegated to you from the bank or who's in your area, and the brokers don't work like that. They only work with the guys that actually can get stuff done. What we've seen is that there's a wide range. Within one bank, you can have different bankers with different experience get totally different outcomes, and your broker needs to know within all the banks who the best person are. They need to know in the credit team who understands rural too. Like, that's the other thing, is that it's all good to have a banker that understands rural, but do the credit guys actually understand your industry or where your business is located? The broker needs to understand that as well and know how to get that articulated to the credit team on how your business operates and what they need to know in a really professional manner. The other thing is around which banks are open to different types of transactions. Like, we've seen it where some banks have retracted out of certain industries. The brokers need to understand what bank's open for beef cattle or poultry, or who's the best person in that industry to go to. By being a customer walking to a bank and saying, I want to buy a cattle station, well, you might get a banker that's never seen a cattle station or been on a cattle station, and how are they going to know how to articulate that to the credit people if they don't understand the industry? So it's making sure you're working with the right people in your industry that actually gets the job done for you. So what happens if you skip a broker? What does going direct mean? Guessing with $1 million decision is expensive, and the hidden cost is something I used to personally see all the time when I worked in a bank. So trust me when I say, banks are not neutral when advocating for the customer. Bank staff, they don't work for the customer, they work for the bank. So whenever you're dealing with a bank, you've got to understand that the first interest of the bank is the bank. And so their job is to minimize the risk and protect the capital and follow policy. At the end of the day, that's their main priority. Where as a broker, we work for the borrower. Our job is to frame the deal in the best possible way to get the deal across the line, explain the volatility, tell the story behind the numbers, tell the story behind the family, and position that risk correctly so that the bank fully understands who the people are. And we refer to the 3 C's of credit around, character, capacity, and collateral. And that's what the broker's job is, to really articulate to the bank those 3 things around who the people are, what's their ability to repay the loan, and what's the security that's been put on the line as the fallback position if the loan wasn't to go to as planned. They're the 3 things, and the broker needs to be able to frame those 3 things in a really succinct way so that the story gets told, so the bankers and the credit teams understand the business and where you want to take your business and the strategy behind it and what the risks are, and being able to mitigate those risks around if things go wrong, what's going to happen next. So this one gets me rolled up because it goes against everything I do this business for. And that's, banks only assess what's in front of them and nothing more. The bank won't optimize a scenario, suggest restructuring, or explore a what-if option. They assess the deal exactly as presented. What a broker will do is they'll stress test the scenario, adjust the structure, change timing, improve timing, and work backwards from an outcome rather than just looking at exactly what's in front of them. Borrowers often get declined for a deal they could have done if it was prepared properly. And luckily, the final hidden cost of going straight to the bank is the cost of bad timing and poor sequencing. Applying at the wrong time can lock in weaker terms, reduce future capacity, and force short-term fixes, where a broker is going to help with sequencing the debt, timing the application, avoiding unnecessary credit inquiry. And this is a hidden cost that you don't often see, is that if you're going to apply at multiple banks, each one of those banks is going to put a credit check on your file, which going to a broker, They're not going to do that. So one rushed application can reduce your leverage for years. An example of this is if a file's been in front of credit regularly over a short period of time, maybe it's better to seek an alternative funding source just to give the bank a bit of time for you to get some runs on the board and then look at restructuring things in the future. And, most lending mistakes don't hurt immediately, but they do over time. And the timing, they show up 5 years later when you go to grow. So using a broker doesn't guarantee approval or better rates every time. But not using one means you're relying on a single bank and a single person and a single interpretation that can often be a big bet with a rural business. So even if you don't use a broker long term, getting a second lens before a major decision can save a lot of money and stress. And good deals fail every day because they're badly presented. By using a broker, you maximize your chance of getting a loan because you've got someone that's experienced, they've got the contacts within the banks, they know how to present your business in the best light possible to get access to the funding. They know they can use a mix of funding sources. They're not just locked into one bank's credit policy, one bank's view on the world. They can go to multiple options. There's no real downside. And the thing with a broker is they only get paid for their results if they achieve them for you. Whereas a bank manager, they get paid no matter what. So guys, I'll share a quick example around where a broker, the difference between using a broker and going directly to the bank. We had a customer that recently looked to buy a cattle station. They've been with the bank for a long time. They spoke directly with the bank, but the policy that the bank had around LVRs and the way they treated off-farm income and adjustment, it didn't fit their policy, but we were able to put it together, structure it differently so that the new bank understood exactly where the customers were going. They were a young couple buying their first property, and what it did was, it was the difference between securing that property and not. And now they're looking to buy their next property after that, because they're able to structure it in a way that was within the bank's policies of their new bank, where the previous bank, it was never going to work for them just due to the restrictions around their credit policies. So, by having the broker there to help you navigate through the policies and which bank is working in which areas made a massive difference to this couple's ability to secure the property, and their family's now, looking to buy another property since that purchase, it's a tremendous story, and it gives us great pleasure to be able to help a young couple buy their first cattle station and then look to secure the next one. So, it's not just about whether using a broker or a banker is a better option. It's around, what's the best outcome for the customer and how do we go about structuring things so that we get a great outcome for their family and for their business. Thanks for tuning in to Dollars in the Dirt. If you've got value from today's episode, make sure to subscribe so you never miss the insights you need to grow your business. And if you're ready to stop being just another number to the banks, visit Seasoned Finance via the link in the show notes. Remember to follow us on socials, and catch you next time.